Welcome everybody. A little bit about myself. I've been doing this a long time. One of the pioneers, as you will, in this industry. Started my own education back in the late 1980s, probably, or maybe not where all of you are, many of you may be, but I really knew absolutely nothing. How do you trade stocks? What's a stock? What's a bond? So on and so forth. After several years of long education of trial and error, which is certainly the expensive way to do it, I founded Pristine and what I'd call the old method of trading at the time that was known back in 1994. I attended many trading expos, traded with live money, with live trading challenges. Won a bunch of them, majority, lost a few. But they were a lot of fun just to show everybody why we do it and explained it. And it was always great fun and very interesting. Wrote a few books. You can find them on Amazon. The latest one, Tools and Tactics, Reading the Mind of the Market. There's a tremendous amount of information and education in there. Definitely something that you'll read several times over to absorb it all. And over those years, I've educated thousands, and in professionals as well, hedge fund managers, market makers. I remember one of my first students in the office that we had many years ago was a specialist, and it was interesting just to hear their stories. We tend to think that these guys that are specialists and market makers know so much, but in reality, they just know order flow, and they kind of have the inside track as to the supply and demand, which today I teach at mastertrader.com, and what I call Master Trader Technical Strategies for today's markets. Here's a picture of myself back, and this is probably 1999 at the first ever Traders Expo, and my booth at the time, and you can see the background, trading, training, technology, and such. It was over 20 years ago. Seems like a lifetime ago. Anyway, a tremendous amount has passed in that amount of time, and instead of educated many from all different fields. At Master Trader, we have a huge amount of information that you can learn from. That's, a lot of it is free of charge. You can sign up for our chart of the week and read those articles that are in there and different charts, talk about option strategies and psychology. And I know that everyone, including myself back then, trying to be a sponge and learn as much as possible. So we do offer a lot of education that you can learn from. And part of what you all do and what we all do is try and fits, meaning as I present, maybe something clicks with you that I say, they say, this is somebody that I want to learn from. And you may hear something from another presenter and say, you know what, that makes a lot of sense to me. And that is what's great about these webinars that you can go to. But I'll tell you, at some point, you certainly have to make a decision to put your teeth into learning a particular method, because one of the hurdles is over-information and doing too many things, and you can spend years trying to figure it out, part of the process. As I went through that process, and I looked at so many different types of analyses and trying to figure out what makes this market move. How can I determine trend changes? How can I determine the turning points? How can I not lose money, right? Which is all of our goals. One of the things that I did and questioned for a very long time was drawing trend lines. Questioned, well, where do I connect the dots? Does the actual break of a trend line violate the trend? Because I saw how many breaks that were false breaks that really didn't result in prices continuing to move lower or higher, and that was very confusing. And I asked myself the questions: am I doing this the right way? Should I connect to the closes? Should I connect to the tails? And so on. And the questions become endless until it becomes a vicious circle of going around and around trying to figure it out. And I say, how many points can I connect to create a maze of confusion? How many times have you thought this doesn't work, but you're still doing it? We've all been there as we try and figure this out. It went on for a while. Here's this saying, insanity is doing the same thing over and over again and expecting different results. But we've all done that, trying to figure out why prices move as they do. Then we have all of the different indicator choices. There weren't as many when I first started out. back in the late 80s. That didn't mean it wasn't as confusing because of all of the different settings that were available and changing time frames and why didn't it go down when it said it would go down, and am I using the wrong indicator or is it the wrong combination of indicators? It went on, and in the end, the thing that was the aha light bulb moment was to remove all of that noise from the charts and just look at the price action, and things started to make sense. And this is what I teach and do today as a trader and as an educator. The old saying, keep it simple, stupid. By removing all of these squiggly lines and what I'll call a spaghetti screen, clarity comes from what you're doing. The less information you have to process, the easier it is to make a decision. Of course, you want to know that you're making the right decisions, and that comes from just experience and using trading style and getting familiar with it in different market environments, and it takes some time. I ask you to look at my screen and ask you the question, would you agree that this is an uptrend? What is the definition of an uptrend? This is how we define it, yet as we open up our trading platforms and we have all of the choices to try and decide what an uptrend is, it's higher highs and higher lows. And it's really that simple. So then as I put the line and connect the dots, I ask you, has the trend been broken? And this is where many of you are probably at. I know this is where I was at as I drew this line and I said, oh, it broke through the trend line. The trend must be broken. And then before I knew it, it was right back up again and questioning, how is this possibly happening? The line is broken. It's supposed to keep going down. These are just a normal correction. And then once you have the line, theoretically, and you extend it into the future, if it's broken, it's supposed to become resistance. That's a flawed concept. As you look at that and you look over to the left of what's there, is there any price resistance? And that's what really matters. Is there price resistance? Now as you look at what's on the right here and you see prices push down through the prior low, is the trend broken? Does it meet the definition of an uptrend? And the answer is clearly it's not in an uptrend anymore. It's violated it. So if we do our analysis by looking to the left and just looking at where the prior swing low is, if prices break down below it, it has to break the uptrend line, if you choose to use one, every single time. And with that knowledge, it really makes the use of trend lines unnecessary, subjective, and a waste of time, in my opinion. Now, as we get to candlesticks, we have to simplify that. Everything that I do, and my focus is simplification, removing the noise. So as I look at candles, I simply look at, is it a green one, meaning it's closing above the open, or is it a red one, closing below the open? Is it a big candle, or is it a little candle? Little candles after big candles mean that momentum is slowing, and big candles mean momentum is increasing. It's that simple. Now, we have candles with tails. Are they big or are they small? If it's a tail on the top, that means it was higher and it went down, and vice versa. Either sellers are taking control or buyers are taking control. And this is what you need to know and keep it simple. Now, the location of these candles and the trend becomes key to them being accurate as to what they're telling me. Let's continue. So here are the common type of retracement patterns. We all look for pullbacks within a trend, whether it's up or down, to enter a position within the direction of the trend. So the ones on the left, the far left, is your normal type of pullback. Now, entry points with this type of a pattern years ago was the bread and butter. Today, because of high frequency trading, you get a lot more whipsaws with it. It is what it is. The next get a pointer here. The next one here is a retest pattern, and I prefer this one. I'll take this one if it sets up properly, but this one here gives a little bit more time and being able to build up a little bit more support, and it tends to be a higher probability setup. So we've got buy setups and we've got sell setups, and we put these pictures in the context of the prevailing trend. And this is the expected result. After a pullback, we look for prices to go up, and after a retest, we look for prices to go up within the trend. Now here is the key point as to the tails and understanding retracements. The bottom of this tail, as we look at multiple time frames, is going to look something like this. It can have different variations, of course, but this is the principle of a bottoming tail and what happens at the top of a topping tail, that there's a transition from a move up to a move down, and what we're looking to do is to participate in the transition, and depending on the time frame that we're using, well, if it's a topping tail, well, we short it under the low of the topping tail. If I decide to take an X-ray into the tail, well, I might trade at this transitionary point. It becomes part of your plan and how you want to utilize this information. Just, I want you to understand at this point that inside this tail is another pattern, and it's going to look something like that. Now, these continuation patterns, one of the things that I had frustration with was that the normal type of retracement patterns happened less and less as the internet evolved. When I started out, there was no internet. You know, you picked up a phone and you placed a trade. And as the internet evolved, things started to move faster, and these retracement patterns happened less often. So I got left behind many times. So then it was, how do I figure out how to get on board? Those corrections that happened in the smaller time frames, probably not looking at them. So understanding that a wide range bar ignites a move higher, and then the move starts, and where I'm looking for that retracement pattern, and it didn't happen, understanding that this bottoming tail bar is actually the correction in the smaller time frame, and this is what I'm looking at, that gives me my entry point. And this is regardless of whatever you're trading, everything's the same. And I'll show you a few different charts of different tradable instruments. It doesn't matter what you trade. There's no perfect instrument. It's about where's the money flowing and where's the liquidity and the certainty within the pattern. Those patterns will tell us when there's certainty or uncertainty. But at the beginning of a move, and I see this bottoming tail bar, and you'll see how I drew this, I wanted to take out the lows. I wanted to break lower and then turn back up again. And again, it can happen in different ways. It might happen this way, it might happen that way. It may happen in ways other than what I'm showing you. And one of the things that I teach students is that if you understand what's happening here and you use what I've coined as bar by bar analysis, you can figure out what any pattern is doing. You can't get hung up on this is the perfect pattern and this is what has to happen, because the market isn't going to bow down to what you want to see. And I know that can be frustrating, so we have to have tools that allow us to operate in any market condition. So as you look at this chart and I say, what time frame is this? And you don't see anything on the bottom, so you might try and figure it out, but in reality, you can't really tell because there is no time. And the point of me asking you this is to tell you that all of these patterns happen in any time frame that you're going to look at, whether it's a retest pattern, whether it's a continuation pattern, whether it's a base, whatever it might be, it happens in every time frame you look at. So you have a choice as to the time frames that you're going to operate in. Now, if you pick a higher time frame for a bias, you can pick a lower time frame for your entry points. If you want to use multiple time frames, but understanding that these price patterns happen in all time frames, you have to come to a decision as to what you're going to use. Otherwise, the maze of confusion continues and the analysis paralysis starts and never ends. So here's two charts. S&P 500, the spiders, the ETF, and on the right is pound versus the dollar. I can see that the pound is beginning to stabilize. There's a lot of uncertainty here, and we define that by a lot of up and down candles overlapping themselves and a lot of tails. And as certainty comes into whatever you're going to trade, the patterns start to clean up, as I would say. And we see patterns just like this. Here's a bottoming tail bar that started after an initial move, and that's your signal. If you were looking at a smaller time frame, you could have caught the move down here. What I'm showing you here is the daily chart, and I see the pattern that's setting up, and I see this big red bar not having any follow through. I don't know that it isn't, but after the fact I can see that, and as things begin to develop and then take out resistance, that provides me a bias that prices can continue to move up. Whereas the S&P has been trending up, and now it's getting a bit whipped, that big tail bar, and now we got this gap up and this reversal. Things are getting a bit whippy, so maybe we're at a turning point here. We're into the end of the year, so most of the times the markets aren't going to fall apart, but tech is getting beat up here. But as you can see, these bars are about equal in size and how this is moving, and now the ranges are expanding. So things are beginning to change here, something to take note of. Part of what I do is teaching how to read price patterns and what they're communicating without the indicators, and getting to what moves, not trying to read what's moving through the eyes of an indicator. Now, here is MO Ultra Group, and this was a bottoming pattern right there, and here's that bottoming tail bar after an initial move up. That gives us our signal that it's going to move higher, and that was, this bar here was the move yesterday as it continued to move up. I was like, well, why did it turn here? I'm always asking myself the question, why does something happen? Why did it turn here? Well, multiple time frames. Here's the weekly chart. So when I combine multiple time frames and I see prices coming down into the area of a prior low, I begin to anticipate that that's where demand is going to pick up, and then start to watch the price action to see if it actually happens. And then once it does, then I go to my bread and butter type of patterns to set up that give me the entry point to participate in a move like this. Now let's associate this to trading gaps, because by doing that, now I can apply this to trading for income every single day. And ideally being able to do that in a short amount of time in the morning. And what we're looking for is shocks. Primarily, I want to see a shock like this that creates these guys managing funds saying, what the hell happened? And those are the guys that are going to start hitting the button that are going to drive prices, in this case, continuing to move lower. And that's part of a rating system that I put together that puts the odds in my favor in trading these gaps. And of course, we're going to utilize what's happening on the daily chart in combination with what's happening on the intraday chart. So all these gaps, they're not created equal. So I have to scan these gaps in the morning, but I'm looking for the shocks. And you can see the ones with the shocks, because they're the ones that if you kind of envision yourself as being in there the prior day, what would you be thinking? Gap down under a big green bar? Not good. Gap down into a little red bar? No big deal. Of course, that's a big problem. And so on. When we're looking for these red candles where prices can gap above the high, and especially if it's a wide bar, that's going to be a powerful signal. Gapping above a base that was preceded by a red bar, that's a powerful signal. We start to look for the same things over and over and over again. So as I look at different patterns, well, gapped above a red bar and resistance. Okay, that's on my list to see what it does at the open. This one didn't clear resistance, but it's a pretty nice gap to the top of the resistance. I'll watch it. Gapping above a red bar. Not all the resistance. I'm going to watch it. I have no interest at all with this gap up because it didn't clear the resistance. A lot of this is common sense. When you come to learn it, you realize it's common sense. And so we're going to combine multiple time frames. And one of the things that I'm going to look for after the gap up is, what did it do the prior day? Was it basing? What was the structure of the intraday time frame? Because it's important, because I'm trading it intraday. If it was going up all afternoon and then gapped up, well, it's not likely to advance as this did. So once I put that together and see what it does in the morning, I look for ideally this bottoming tail bar I could trade it at the bottom of the bottoming tail bar. It's another strategy, but let's just stick with this one for now. And once it does that, it gives me my entry point. I put a stop down here, and I wait to see what's going to happen. So here's other examples. There's a retest of a prior topping tail, and it gaps down, and an end-of-day base the prior day, shorted under the first 5-minute low. A lot of trading is, once you have your setup, just waiting to see if you're right, because in reality you don't know, and that's why position and money management is so important. We don't know. So indicators and whatever you're going to put on your chart doesn't guarantee a win, but what we're focused on is putting the odds in our favor. Here's another combination. So there are different setups that could happen. As we look at this particular one, I see the gap down under a base. That suggests to me it's going to keep going lower. I look at the structure of the intraday chart. What was it doing the prior day? In other words, what was happening inside this candle, the last candle before the gap? And I see it was going sideways. So it was building up this area here that could have been support if it gapped up, but it gapped down. And I look at these individual candles. I said bar by bar analysis. The prices broke out into the end of the day and came back in. Now, if it opened higher, no big deal, but it gapped down. Now, all of these buyers, why they were buying here, who knows, but those buyers are now caught, and as it moves down, it's likely to keep going down. Bias from the daily chart. I look for an entry point, just a normal old retracement toward an area of resistance, and a topping tail, sell it short. I wouldn't suggest putting a stop above these highs. I'd put it a little further away because a lot of times this one worked out, but a lot of times the wiggles here will stop you out and then you'll see it go. Management is, so this is how I look for these gaps in the morning, and I've set up a page. This is TC2000. And it scans extremely fast. It's easy to use. TradeStation's a nice program as well, but easy language is not easy whatsoever. This is really easy. And I've set up these scans that look for percentage gaps, and then is it trading above or below yesterday's close, today's open? Is it gapping below a green bar? Is it gapping below the low? Down here, is it gapping below that big green wide range bar? I don't get too many, but they work. Is it gapping above a big red bar? Some low-priced stocks as well, and what's moving. So all of this happens instantaneously, and then I just click on these and look at my charts, and hey, here's a nice base. It's gapping under the base. It should keep going. Look for an entry point. So if it's an end-of-day base, daily is set up in this way, I'll be more aggressive right at the open, the first 5 minutes. It could be 2 minutes. If it's a little more questionable, maybe I'll wait. I might miss the move, but again, that's part of trading. What's your plan? How are you going to handle that? So putting this all together, which I have, and what I'm going to offer to you is a gap trading class. Any of you that are familiar with some of the gap education that's out there, it ranges in price from $1,500 to several $1,000s. Many of those that are teaching it, I educated them. Over the many years that I've been doing this, I have put together a fantastic gap trading class that I'm offering on my website for $495 for the complete class. But here I'm offering the complete class for only $195 at the checkout. Enter that code MTSGAP2017 and you'll get the complete class that you can listen to over and over and over again, and it'll put together the whole system that I've taught many traders that earn an income do it over the years, and there's no reason that you can't do it too, because all you have to do is follow what I am teaching and then become familiar with it. And of course it'll take a little time to understand different market environments, because with any type of trading or any profession, it really comes down to experience once you've gathered the knowledge. So I hope everybody's enjoyed this. You can email me if you choose at greg@mastertrader.com, or just go to the site, sign up for the course, and you can access it immediately.